Good morning, everyone. My name is Ray Vargo, and I'm the director of the University of Pittsburgh Small Business Development Center, which is part of the Institute for Entrepreneurial Excellence here at Pitt. Today's program will focus on the employee retention tax credits available through the CARES Act and the Economic Aid Act. I encourage you to visit our website at entrepreneur.pitt.edu to view current information about these programs and other resources available to your small business. Please know that our entire team at the Small Business Development Center and the Institute for Entrepreneurial Excellence stand by, ready to assist you. A few housekeeping issues this morning. Please make sure to mute yourself. Want to make sure that everyone has a copy of this morning's presentation. It has been sent to you this morning. You could check your email at 8:43. Terry Cook from our team sent you a copy of this morning's presentation. If for some reason you did not receive it, please email us at sbdc@pitt.edu, and we'll be sure to get a copy to you. If you do have questions throughout this morning's program, please use the chat feature. I'll be moderating the chat feature, and we'll be addressing some of the questions throughout the presentation, but we'll make sure we provide ample time at the end of this morning's program to address those questions and concerns. You will be receiving a survey regarding this morning's program. We would ask that you provide some feedback, not only on today's program, but also additional topics you would like to see addressed in our future programming. So this morning's program is on the employee retention tax credits. And I would really like to thank the entire team of Wilke and Associates who will be delivering this morning's program. I would like to introduce Maria Strompel, who is a partner at Wilke and Associates, and her colleagues Kim Brennerman and Kelly Glenn, who are both managers at the firm. The entire team at Wilke and Associates have been longtime partners of the Small Business Development Center and Institute for Entrepreneurial Excellence, and we thank them for their continued support of our programs and our willingness to conduct this morning's program. This was a follow-up from a program we held last month regarding the new changes regarding the Economic Aid Act, and we saw that many individuals wanted more information regarding the tax credits that are available to many of our clients, members, and participants of our programs. So I'd like to say good morning to Maria and ask her to proceed with this morning's program. Good morning, Maria.
Good morning. Thank you for the great introduction. It's a pleasure to be able to do this presentation this morning. I know that myself and Kim and Kelly and the rest of the Wilke team have been dealing many weeks with our clients trying to work through some of these regulations. And it may appear to be straightforward, but once you actually start to dig in and get some of the situations and fact patterns, it could be a little bit tricky. So we're hoping today we can help eliminate some of the vagueness that might be around the employee tax credit. So I'm going to just start with just a general overview. What we're planning to cover this morning is pretty much spend a little bit of time with the government order and the shutdown and the partially suspended roles around that. And then Kim is going to cover the actual retention credit calculation, and Kelly's going to work more towards how to apply for the credit and how to actually go. And if you're in the situation where you have to amend your 941, she's going to kind of walk through a really nice detailed explanation. And then we're going to wrap it up with, is the credit deemed to be taxable? How do you treat that? What's the impact on your business expenses? Okay, so I'm going to give just a real quick overview to start with. Back in March of last year, the CARES Act actually passed the employee retention tax credit, and it was really to allow for eligible employers to have the opportunity for a refundable tax credit for wages paid to employees during periods where the business was either under a suspension or a shutdown, or they had a significant decline in revenues. Now, a lot of employers really didn't benefit much from that last year, primarily because a lot of business owners went out and got PPP loans. And because of that, there was a restriction where if you went out and got a PPP loan, you couldn't use the tax credit. So what happened towards the end of the year, towards December 27th, there was a new act, the Consolidated Appropriations Act, CAA, which then came out and said, you know what, even though you went out and got your PPP loan, we're now allowing you to also be able, as an employer, to take a retention credit, provided that you're not using the same wages that were paid by the PPP loan. So you couldn't necessarily double dip, but it was allowing for the opportunity to reevaluate whether or not now you can actually go back a year ago and go through your payroll and see if you can indeed get a tax credit. So I want to just kind of compare the credit, because it kind of changed between the year 2020 and the year 2021. And so I just want to kind of give you the timeline. So when this credit came out, it said, okay, any wages you paid between March 13th through the end of the year could be eligible for this credit. And they're looking at, for each employee, the qualified wages can only be $10,000, and the employer would be entitled to a 50% credit of that $10,000 per employee. So it's a year credit. The maximum amount that any employer could get is $5,000 per employee. If you're trying to get the credit based on a decline in your business, you have to have a 50% decline in your gross receipts. And if you're an employer that was more than 100 employees, you actually could take the credit for employees you're not providing services. And we'll walk through a lot of detailed examples to make that a little more clear. The other thing I wanted to talk about is that particular credit change, and it got expanded into 2021. And the difference really is that they're saying, okay, each employee now, if the employer qualifies, is actually able to take a $10,000 credit per quarter for the first 2 quarters, starting from January 1st of 2021 through June 30th, 2021. There was a difference also in the decline of the gross receipts. Now for 2021, you can actually look at a 20% drop as opposed to a 50% drop. And they actually look at the quarters of 2019 compared to 2021. And the reason they actually look at those quarters is because the likelihood of having a decline is greater using that measurement. But they also, for the year 2021, said, you know what, we're also, instead of having to wait till your whole quarter is fulfilled, you can actually go back to your 4th quarter of 2020. And if you have a decline of 20% or more, you can actually start to use that as your measurement. And Kelly will kind of walk through some of the benefits of that as well. I also want to explain that that's explanation I gave you, the comparison is really about the decline, and it also pertains if you're suspended by a government order. So I wanted to explain there was some confusion, and some people thought you had to have both. But there's actually 2 ways to qualify. One, you're an employer that was either affected by the business operations by being fully mandated as a shutdown, or it's a partially suspended operation, or if you happen to meet the substantial significant decline in gross receipts. So it's an or and not an and. And I wanted to point that out because a lot of people thought you had to have both, and you don't. But you can use them interchangeably, meaning that when you look out to the year 2020 and the year 2021, you may be in situations where you might be using a quarter to meet the credit because of the decline, but you might be using a different quarter because you've been partially suspended. So you can mix or match that. So that's important to be in front of you when you're focusing through your payroll, that you're not restricted to only one method. You can use both methods. And we'll have a lot of examples explaining that. The other thing I wanted to point out is, as an eligible employer, what they look at is for the year 2020, they're looking at the 2nd, 3rd, and 4th quarter. But in your 2nd quarter as your measurement, you also include March 13th through March 31st. So that short 2-week period is also included in the 2nd quarter and when you're doing this measurement. The other thing I wanted to point out is that I'm going to go to the eligible employer definition. There was a little bit of confusion as to who's a small employer, who's a large employer, and how you compute the full-time employees. So a small employer is deemed to be an employer that has an average of 100 or fewer full-time employees. And what they're using for that measurement is 30-hour weeks per week or 130 hours per month. And Kim is going to walk through some of this information, but I don't want you to think that when they talk about 100 or less full-time employees that you have to have 100 or less. Each and every one has to be full-time. No, you can have some that are full-time, some that are part-time, as long as when you take the average of all your employees that you don't go over the 30 hours per week or the 130 hours per month. The other thing I wanted to bring up is that the credit eligibility, whether your employee is working or not. So the original law said if your company had more than 100 employees, no credit was available for the wages paid to an employee performing services for the employer, whether they're teleworking or they're working at the workplace, even though they had a reduced capacity due to the business being reduced because of foot traffic. But a company with 100 employees or less is eligible for the credit even if the employee is working. So there's a distinction of whenever you go over that threshold of 100 employees versus under 100 employees. The new law pretty much says the same thing, except that they use 500 employees. So now they're looking at 500 or less when determining how to calculate the credit. And the other thing I wanted to be mindful is that when you're doing the tax credit, the employee retention credit, that you have to look at common ownership. So you have to look at all your affiliations and make sure when you look at each location, you actually quantify and calculate those employees per location to make sure you're not going over that threshold. All right, so now I'm going to talk about where I thought a lot of the confusion was coming into play. So I'm going to talk about the first criteria, not the second criteria, which is a decline in significant gross receipts, but the first criteria, which talks about being mandated to shut down your business or being partially suspended. So, when the government came in, and this includes also like federal and state and local government, and they came in, they mandated and said, okay, we're going to limit your hours of operations and so forth. What the IRS said is that they looked at this and said, okay, if you're an essential business, that you could never benefit from this credit because you are essential and you're required to be open. And I'm paraphrasing that. But if you're a non-essential business, then you are mandated to shut down, and so your business is being impacted. And we'll walk through examples, but at first blush, that's what the rule is saying. But as we further dig into it, we'll find out that there are exceptions to the essential business. And there's ways where you can qualify because you're being impacted in a different way, more or less indirectly by that order. The one thing I wanted to make sure that everyone was aware is that if you have a voluntary change in hours that you just decide, to lower your hours of business, that doesn't qualify. So it can't be a voluntary change to be treated as a partial suspension. So let's talk a little bit about the complete or partial business suspension. So a suspension of business means that employer's operations have been limited, whether completely or partially, because the government ordered that effect on commerce or travel. This means that it limits the number of people who can meet in one place, or it orders the business to reduce their hours. Also, if an employer can carry on a business completely remote through teleworking, despite the fact that there may be a limited office presence, maybe no office presence, it's not deemed to have experienced a suspension of operations. So that's really important, that if you're able to, as an essential business, operate and conduct everything seamlessly remotely, that you're not deemed to be impacted. That's the general rule. So let's talk a little bit about essential business. There's in the IRS, they have some frequently asked questions, and there's probably a good 10 or 11, maybe 12 questions that surround what I think is a gray area here. And I want to walk through a couple of them to help you understand the exceptions to the general rule for essential businesses. So I'm going to start out with, there's an IRS question number 30, which pretty much says, okay, even though generally an essential business is exempt from the direct orders, there will be a situation where if you're impacted because your suppliers are impacted and they're deemed to be a non-essential and you can't get your delivery of supplies, then you as an essential business are impacted. So, you start out with the role and then you kind of go into the gray and you go through a fact and circumstance where you got to look at each of your cases separately and kind of tear it apart and say, okay, can I meet this credit? Can I somehow work around the general rule and fit into the exception? And the answer there is absolutely. So I'm going to walk through an example. So example one, the employer A operates an auto parts manufacturing business and is considered to be an essential trade or business in the jurisdiction. The employer A supplier of raw materials is required to shut down its operations due to the order. Employer A is unable to receive the raw materials from the supplier. And as a result of the suspension of the employer A supplier, the employer A is not able to perform its operations. So under these facts and circumstances, the employer would be considered to be an eligible employer because its operations have been suspended as a result of the order that suspended its supplier. So even though the essential business wasn't directly impacted by that order, they were impacted indirectly because of their supplier not being able to deliver to them for them to perform their work. So I want to give you some key takeaways when you're going through these facts and circumstances and you're trying to figure out how do I fit into this. The key points that I wanted to just give you as a general rule to follow is you need to identify your vendors and how your vendors were affected by the government order. You need to identify if the orders have resulted in essential business not being able to conduct specific activities in their business operations. And some of that would be demonstrating that, there was a supply chain disruption, which is what I just went over, the fact that you can't get your supplies. And also, there's a reduction of work hours or workload. Those are items that you can work around that rule, again, for an essential business. And then for one that's a non-essential, this is not an issue. The other thing I wanted to point out is that the IRS is really not looking at the foot traffic of a business being a reason. They're looking at the supply chain. So that's really important. Like whenever there's an order that says you're required to stay home, and because of that, it lowers the traffic, it doesn't necessarily mean you're impacting your essential business.
Maria, this is Ray. Question I'm sure that some of our participants on this morning's webinar would have is what type of documentation, again, in the example you provided with the manufacturer and not being able to receive parts from its supplier, um, what type of documentation does the business need to keep or prove in order to be eligible? Is there any kind of guidance you could provide there?
Um, I would think that, in some cases, there were like contracts that were canceled. That would be a good way of saying I've ordered, X amount of certain raw materials or auto parts or whatever, and you have an actual purchase order and it's been canceled because the factory's been shut down for a couple months. That would be pure documentation. Here's a specific contract I have and it's been canceled, over and above knowing that, hey, in that particular jurisdiction, they mandated, these hours or mandated a complete shutdown. I mean, I would think when you have that in hand, that's pretty telling. Any other questions? Or that was just you were hoping for some more guidance there, right?
No, I know people always worry about after the fact is that am I going to have the right information to in order if I were questioned of the legitimacy of my eligibility or not. And so a best practice is always is to either have something in writing, as you said, a contract, a canceled order, or if not, some type of proof that in that jurisdiction of your supplier, or even an email from your supplier stating that we cannot fulfill your order at this time due to government regulations or our problems with our supply chain. Something that you could have in your file in case there ever was a question in the future. That's all I would point out as a best practice.
I agree. I totally agree. And if I haven't driven this next point several times, I'm going to drive it home one more time. That if the government, whether it's state or local, is requiring you to stay home, that's not deeming your business to be fully or partially suspended. So I always refer to it as foot traffic, um, and there's a reason for that. I'm gonna walk through another example. I have an employer, and I'm gonna use could be engineering, or I want this to be a essential business that is not required to close their location or suspend their operations. And due to the order, it limits the travel and requires members to stay home except for essential travel to like the grocery store. Um, and in this case, the employer's business has declined. They really have declined their business because of this. They're still saying that the employer B is not considered to have a full or partial suspension due to the order. And in that case, my answer to that employer would be, now try to see if you can get the credit under the decline, the significant gross receipts decline, because you're not going to get it under the suspension. All right, so I want to talk about, again, the best example that I gave earlier is that an essential business, and I'm using a Pennsylvania production, is shut down because of state restrictions, and an Ohio manufacturer, which is deemed to be an essential business, is unable to operate normally due to lack of material. The Ohio manufacturer could be viewed as an eligible employer and be able to get the ERC under a partial suspension guideline. So anything that is indirect for that essential business seems to be the way around it. Okay. I want to cover, just to make up some time here, I'm probably going to cover, we go to maybe slide 20. And the distinction that I wanted to make, and this is really, I think, the IRS, unless they change these roles, they are really not measuring the customer impact here. They're only looking at the effect of the lack of supplies coming in to that business. Another walkthrough I wanted to go through is the partial suspension. And this is going to talk a little bit about indirectly how an essential business is being impacted, looking at the limitation of operating hours, the availability of parts, and even the timing of your deliveries by that common carrier. And the reason I just kind of give you general guideline is because we've been very fruitful in finding ways to get the credit by looking at the other variables around the impact of the business. Because again, the role is focused on commercial activity, travel, any type of group meetings. Those are restrictions that they deem to be partial suspension of operations. And I want everyone to focus more on the direct impact around that. So it's important that you kind of look at some of the locations that are being partially closed. So I'm going to walk through an example, which I think we have a lot of clients in this industry. Let's take a look at the restaurant business, for example. Now, they were closed. You had certain restaurant locations that had to close their in-room dining because of the government orders. And so this impacted the restaurants and bars and similar sit-down establishments. And the employer was still allowed to continue to have food sales through carry-out or drive-through or delivery. And so in that particular case, that business is considered to be partially suspended because they weren't totally shut down, but they still had a suspension in their operations. So that would qualify. And a lot of our restaurants were able to get a credit based on looking at the restrictions of in-dining. Let's take a different approach. Let's look at the retail business. So the retail business was forced to shut down like their storefront, but at the same time, they still had their website that was open. People were still ordering online. And there, it was also considered to be partially suspended because you didn't have the foot traffic of the brick and mortar, but you still had your website orders coming through. The fifth example I wanted to walk through is also another good example that I think impact a lot of other industries. And one is dealing with like the trucking company that, you know, they're deemed to be an essential business, and they could partially be suspended because the customers have closed their physical location. So here we have like a common carrier trying to deliver to a physical location that's been shut down. So they're indirectly partially suspended because of that order. And so you have to look at each of those circumstances and see how it fits into the regulations. And so these examples were really pulled out to help you navigate through the gray area. Because when they say that the essential businesses are not eligible, that's not so true. You need to go through these facts and circumstances, and you'll find that in many cases they are. I'm going to walk through the other path, which we had some success, is in the reduced working hours. So, you know, if you have a business that reduces its operating hours because of the order, that's pretty easy to get a credit because you can physically look at the original hours that the business was open versus the new hours. The other thing that came up is, you know, some clients are like franchises or chain stores that are throughout all the states, you know, nationwide. And so in some states, they had different mandates versus other states. So how does that impact that particular business? And my understanding of that is that a lot of the companies that had a chain of, say, maybe even a company that had a presence in all 50 states, that the corporate office is mandating some type of policy of how to deal with the shutdowns and the partially suspended locations. And they pretty much said that if you have to operate on a consistent manner in all the jurisdictions, then it is deemed that the employer would be eligible to get that credit for all the locations. So that was more of an internal policy of how to deal with it because of the variations between the various states. I want to talk a little bit now about, we talked about the hours being restricted. I want to talk a little bit about reduction of workload. And I think I'm getting close to slide 31. So here, I wanted to walk through an example, and this has to do with a business that actually goes out and stages homes and has furniture and kind of goes in there and does their thing. And this example deals with having more than 100 full-time employees. And so the employer can't perform their usual services by delivering and installing the furniture because the open houses are prohibited in certain service areas. So the employees are required to provide, updates to the employer and so forth. So at the end, what's happening is that the employer is paying wages to employees at their normal rates, even though the employee is not providing any service. So the employer can determine that its employees are working about 20% of the time. And so in this case, the employer can treat 80% of the wages paid as qualified wages. And the reason why that's important, if you remember when I first started out the presentation, we talked about, large employers, small employers, and in this particular case, this employer is over 100 employees. So you're looking at pretty much at the wages that you're paying for them not providing services. So that's really important, for the wages not providing services. And that's the piece that's eligible for the credit. We go through another example, because that's kind of hard to digest, because you're thinking, I'm getting the credit in a different way here. So this illustration, which is example 6, talks about a fitness club, and they had an average of more than 100 full-time employees as well. And they were mandated to shut down locations, but they had some managers that were working and doing some administrative work. And the employer determined that only 10% was the typical work hours. And so in this case, the wages that the employer is eligible to receive a credit on is 90% of the wages paid to the employees during the period the club was closed. And I'm going to end with a final example, which is going to be a little bit different than you would anticipate. But here in example 7, a large consulting firm was employed an average of more than, again, 100 full-time employees, closed their offices because of the government orders and required all the employees to telework. Okay. So even though the employer thought that the employees were not as productive, they were working remotely and they were all working their normal business hours. Because of that, because there's no change and no portion of the wages they're being paid to the employees qualify as wages. So that's real important. If you're an essential business and you're working remotely and there's been no reduction in workload or work hours, guess what? You're not going to be entitled to the credit. I thought the examples were really helpful because you can read the rules, but until you actually get an opportunity to apply the rules, it doesn't sink in. So I thought the examples would help you through the gray areas. And so I already walked through the first criteria of how to get the credit. Now Kim is actually going to walk through the second criteria of the way to be able to get the credit. And she's going to walk through the significant decline in gross receipts and walk through examples and explain that in fuller detail.
Yes, so while Maria's areas were pretty gray, this is pretty black and white. For the significant decline in gross receipts, we're all pretty familiar with that now, as we looked at that previously for whether or not you were allowed to apply for PPP round 2. But here, in order to be eligible for the employee retention tax credit, in the year 2020, and I'm going to flip back and forth because there are different calculations for both.
I don't want to move too much, and that's right. So,
David, I think you're on. Sorry. So I wanted to walk through between 2020 and 2021. There are different calculations. So for 2020, you can compare your gross receipts for the quarter in 2020 as compared to the quarter in 2019 to see whether your gross receipts had a reduction of 50 or more percent. One thing I did want to note here is that if you apply during, switch back here. If you are looking at quarter 1, the only wages that are applicable for that and eligible for to be included as eligible wages are wages that were between March 12th and March 31st. And if you are applying a credit for those periods, it's going to be during an amended Q2, and Kelly will go over that. All right, so I want to move on to 2020. For 2021, there is only a 20% required decrease in gross receipts in order to be eligible. So it goes from 50% in 2020 to a 20% decrease in 2021. The 2021 quarter is compared back to the 2019 quarter. They also give you an alternative. So like Maria had mentioned earlier, as that if you had that 20% reduction in Q4 of 2020 as compared to Q4 of 2019, that will allow you to claim the credit in Q1 of 2021. Gross receipts, we just want to go ahead and define those a little bit for you. It's going to be the sales of any products or services, any income that comes into you. So whether that's passive via interest, dividends, rents, royalties, all of those things count towards gross receipts, but you do get to reduce that by any returns and allowances. The calculation is a little different for sole proprietors, independent contractors, and self-employed. It's your gross receipts minus your cost of goods sold. So more along the lines of what your net income would be. All right, I'm gonna skip ahead to qualified wages. So normally when we think of qualified wages, we think of just gross wages paid, but this has also expanded to include the employer portion of health plan expenses. So that's a good gain. So again, these wages must have been paid between March 13th and the end of 2020 to be applied for the credit in 2020, and then from January 1st through June 31st for the the year 21 credits. Okay, so for 2020, they look at your eligible wages for the entire year for 2020. So the most wages that this could be applied to for any employee, if you qualify for all the quarters, is just $10,000. Then the $10,000, you get 50% of that. So that would be $5,000 per employee for the year. 2021 is much more beneficial. If you are eligible for the credit during 2021, they look at the wages by quarter. So we're talking about $10,000 per employee per quarter of eligible wages. The percentage also increased. It went from 50% in 2020 to 70% in 2021. So that's a maximum of $7,000 per employee per quarter, or the way it's laid out now, being eligible for quarter one and quarter two of 2021, that's $14,000 per employee. So there are limitations based on employee population. So for 2020, if you have less than 100 employees and you meet the gross receipts or partial or complete closure qualifications, all of your wages paid, including that employer health plan cost, is an eligible wage. If you had more than 100 employees in 2020, then only your employees that you paid for not working are eligible for the ERTC credit. Now that switches for 2021. The threshold is just different. Instead of 100 employees as it was in 2020, it's 500 employees. Okay, so we're going to walk through the definition of a full-time employee. And that is at least 30 hours of service per week or 130 hours of service in a month. So this can be beneficial when you do your head count and you had 2 employees that worked 15 hours a week. That is going to count towards your full-time employee head count as just a single employee. All right, flowcharts. Because this is that complex, we're going to walk through it this way. So we're going to start up here in the upper left-hand corner, and this is for 2020 again. There's a different one for 2021. Was your business fully or partially suspended due to government orders? If the answer to that is no, we're going to go over here to the gross receipts. So the government didn't tell you you could shut down, but you did experience significant impact due to COVID, and your gross receipts were down by more than 50%. Okay, if either of those two things hold true, then you get to go over here to, did your business have less than 100 employees? If it did, you qualify for ERTC for that specific quarter. If you had more than 100 employees, then it just goes to whether or not you were paying your employees for services that they were not providing. So if they were staying at home and watching Netflix and you were paying them to work, you can get the ERTC. Let's go through all the ways that there is no relief. So if you did have 50% or didn't have 50% in the quarter, but you did in the preceding quarter, and then your gross receipts went up, but they were still less than 20%, then you can still qualify in that quarter. And then if you, the quarter that you go up over the 80%, again, you still qualify for that quarter. You just can't do the quarter afterward. So a pretty complex chart, but if you follow through and answer your questions, yes or no, it should lead you to the correct conclusion. This changes slightly and is a little more simple for 2021. Whether or not you were impacted by COVID, government shutdowns, which are a little less likely in 2021. And then this should be 50%, not 80%, I'm sorry. So if you had a 50% reduction, or a 20% reduction, I'm sorry, that's right, 80% there. So if it's a 20% reduction, you do apply, you can get that ERTC credit in 2021. Here, that the hours are not, excuse me, not the hours, the employees are going back up to 500 here as opposed to 100. And still you have the option for paying people that are not working and receiving the credit for that. Some other changes that we just want to touch on briefly. In the original law, if you had increased your pay, your employees' pay prior to 30 days before March 31st or March 13th, you could not claim that. But that is now no longer the case with the December 27th bill. Also previously, governmental and tax exempt entities were not eligible, but they are going to be eligible for just the quarters in 2021. Okay, so some examples to make this real, because those were a lot of words. If an employee has less than 100 full-time employees, so we're paying people to work here, and their gross receipts went down, so you can see here that the gross receipts were down by more than 50%, this Q2 qualifies. For Q3, they were still down by at least 20%, so they qualify in Q3. And then in Q4, you can see that gross receipts went up. So they were only down by 17. You're still eligible for the fourth quarter, but you're going to stop being eligible at the end of the fourth quarter. Okay, so let's see how that applies to that company's wages. In the first column, we see the wages that were paid in Q2. So again, in 2020, we're only looking at annual wages, and the maximum is $10,000 in wages. So for employee A, sorry, let me get to the right slide again. Okay, so for employee A here, they made $8,000. So we get 50% of that $8,000, which is $4,000 credit for Q2. Employee B, as a separate example, they have $12,000 in wages that quarter. You can only get up to $10,000. So the credit for them is $5,000 and they've maxed out. Let's continue with employee A for their Q3 wages. So $8,000 and $7,000 is going to put them at $15,000 over the cap. They've already received $4,000 in credit in Q2, so they can only get the $1,000 credit in Q3. And I think the rest of this is pretty self-explanatory, but those are just wanted to walk you through those couple peculiarities. And that's just in words what we talked through in the slide. Our second example is, well, example 9 here is for 2001, where a company still has, so the thresholds went up for full-time employees, it's now 500. And we can see that the gross receipt reduction here was 22%. So they're eligible in Q1 based off of Q1 2020 wages. We had spoken about a little earlier where you can use the preceding quarter to determine whether or not you're eligible. So by qualifying in Q1 by actual Q1 gross receipt reductions, you're eligible in Q2 as well. Okay, so let's walk through an example for employee pay here. Employee A makes $8,000. They are eligible for 70% of that $8,000, which is a $5,600 credit. Employee B made $12,000. Still, there is that maximum of a $10,000 limit for wages for this quarter. So we're going to do 10,000 times 70%, you get a $7,000 credit. Let's switch to what the employees were paid during Q2. This is looking at Q2 wages solely again, whereas in 2020, we were concerned with the whole year's wages maxing out at $10,000 in eligible wages. In 2021, you're looking at Q1 separately and Q2 separately, and each employee has a $10,000 max. So again, we can get, the employee was paid $7,000, they get $7,000 times 70%, a $4,900 credit. The employee B has $14,000. We're capping it at the $10,000 eligible wages, and they get $7,000 of that. All right. So here, example 10, if an employer qualifies during the first quarter of 2021 and the second quarter of 2021 and pays $10,000 in qualified wages to an employee during each quarter, then
you know, we thought we would be growing a little bit like this year, and you know, even with all this,
David is on. We
David.
have to mute David. Okay, so that.
Sorry about that. Then the employer can claim a credit of up to $7,000 during each quarter for this particular employee. Furthermore, if that same employee for that same employer was eligible in 2020, they could have gotten a $5,000 credit. So we're talking about $5,000 credit for an employee in 2020 and up to $14,000 for an employee in 2021. That maxes out at $19,000 per employee that you can gain from this credit. So, I mean, it's a potentially a lot of money for your business. Okay. I'm going to go over using ERTC with PPP. So, as Maria mentioned earlier, you cannot double dip. However, there are ways to use them in conjunction. So with that said, if you use PPP money to pay wages, those wages are not eligible for the ERTC. So let's walk through an example, and this one's going to be a pretty straightforward example of how to apply that. So let's assume company A gets $300,000 based on their 2019 wages. And that's 2.5 times their monthly payroll cost of $120,000. Okay. Company A gets this money on February 15th, and they're going to use it over a 24-week period. Company A has 10 employees, right? And they've decreased their average salaries from 2019 because of COVID, and it's going to take them 14 weeks to spend the money that they receive via PPP. So that's approximately $21,400 per employee. But the company is also eligible for ERTC in 2021. So you're going to try to use you're going to use the wages to reach your ERC maximum of $10,000 for employee prior to starting to use the PPP money. So if we look at it in this example, so let's say each employee is going to make the $10,000 before February 15th, then you can use all of that $10,000 per employee times the 70% to get to the $7,000. And then you'll use wages from February 16th forward to as your PPP covered period. Not that I have an example for this, but if your periods overlap, like if you can't get to the $10,000 prior to your PPP money coming, you can allocate your PPP money like equally by employee over your covered period and figure out the amount that you're actually paying as a company. That's definitely a more complex calculation, and it's going to be on a company by company and employee by employee basis. Okay. Kelly, did you want to go ahead and talk about claiming the credit?
So now that Maria has given you all of the background and Kim's kind of shown you some of the benefits, the amount that we can potentially claim, I'm sure you're all sitting there saying, how do I do this? And normally it's going to begin through your 941, which most people have their payroll companies take care of for them, along with all of the other quarterlies. However, because it was changed so late in 2020, we now have the option where we can go back and amend those in 2020. And then we can also do it going forward, as Kim explained, for the first and second quarters in 2021. So Kim, can you go to the next slide? So we have to report the total qualified wages per quarter on the 941. That includes any reduction that you may have paid any employees that were done as sick leave or qualified family leave that was part of the Families First Corona Act that was part of the first signing back in March of 2020. So again, as Kim said, we can't double dip. Well, now we can't triple dip. We can't take sick leave. We can't do PPP and ERC all on the same wages. So we have to segregate out before we do any type of calculation. And then we have two ways that we can do this. So we can do it by the 941 and withholding payment of our required deposits, or we can request an advance on the credit with a new form that the IRS put out, which is the 7,200. So it's an advance payment of employer credits. So this is what a typical 941 would look like if it was filed knowing that you were going to be eligible and you had your wages already segregated out. And again, this is by quarter. So you have your total wages on line 2, your federal income tax, and then lines 5A through D separate out for your Social Security and Medicare wages. Now you'll see here 5A I is the qualified sick leave wages. So that is segregated out again for us because that was paid for somebody who may have needed to be home to care for a child who was not in school or may have had to quarantine due to an exposure to COVID. So then it goes through the calculation of the taxes that were withheld and the total amount. So then we get to the very, very bottom and it starts to break out what is non-refundable for us. So The sick wages that you paid along with the tax are non-refundable. So that's automatically going to stay with the IRS. We can't hold back that money. So what the IRS then said is we need to segregate and keep the non-refundable portion separate from the refundable portion. And they created worksheet 1. So next one, and we'll come back to this then. Yep, one more. There we go. So worksheet 1 is going to pull the information off of the 941 specifically in regards to the taxes that you paid and what they were paid for. That helps us to determine what is refundable versus what is not refundable. And I don't want Kim to switch back and forth because it'll get very confusing. But the worksheet that the IRS created is actually line for line, and it tells you exactly what number to pull from the 941 so that we can calculate out the employer portion that is what is deemed to be refundable and what it needs to be held for your tax liability. And they do it by each section on the 941. So this is the first section of the worksheet. Step 1 corresponds to your regular wages. Step 2 on the worksheet corresponds to the, Step 2 is for the qualified sick wages that were part of the FFCRA. So if you don't have any wages that you paid here, then nothing here would count. Then when we get to the third step, this is where we have to break out what the wages are and what the amount is that you paid for the health plan. If you don't have any health plan, then it's just your qualified wages. And then at the very end, we can calculate out what the refundable portion could be. And I say refundable is if you paid all of your taxes for the entire quarter, then you've, in actuality, you've overpaid what you're required to deposit for that quarter. So we can go back now and say, do we want to file an amended 941 for the quarters, in particular 2020, because we've already been through the year and we weren't allowed to claim these until they changed the law at the very end of the year. And most businesses at that point had no clue that they could start to claim this. So now we need to go back and say, oh, I think we need to amend our 941. We need to say that we're qualified for the ERC, and we want to either A, have that money applied going forward or request a refund. And most of your payroll companies are, as it says, coming up to speed with this and are adjusting the systems accordingly. And more importantly, for 2021, they have set up specific codes so that when you are doing your payroll, you can immediately just say these are ERC qualified wages right off the bat. And you don't need to go back and reclassify or do any calculations to determine, can I hold back on paying my tax or do I need to pay it? So we can either, like I said, we can file the 941 amended. And to do that, we do it by quarter. So we would do Q2, Q3, and Q4 in 2020. For the wages that Kim mentioned paid March 13th through the 31st of 2020, they actually are going to get lumped in with Q2 on the 941. So what this form is here is this is what an actual 941 would look like using the same figures from a 941 that would have been filed if we knew we were going to claim that credit. So for this, we want to check box 2 because we over-reported amounts on our original 941. We have to certify that we are filing or will file all of our W-2 or corrected W-2Cs that are required. So then In this case, you either select 4 or 5. 4 is if you overreported, and 5 is if you want to claim the refund as opposed to applying it going forward. There's no straight answer as to the best option for which to do this. Some of these amounts seem somewhat high, and because of the timing, we're suggesting on some that it might be more beneficial to just do the refund. If others have the ability to just have the application and have it applied to future quarters, then albeit we would obviously check box 4C. But in our example, we opted for it to be completely refunded, and thus we picked box 5D. Okay, so Kim, next slide, sorry. Okay. Part of the calculations and the amounts of the refundable versus non-refundable actually gets separated out on the 941X, which is what you're seeing here. And it probably looks a little confusing to you where the refundable portion, or I'm sorry, the non-refundable portion as a negative, which in reality, yes, it wouldn't be refundable. So we should say that it's $17,698.44. However, we already paid that. So really we want that back because we paid more than we should have. So the instructions on the 941X will tell you that if it's a refund amount, the amount in column 4 would be a negative. Then we go down to the part where this would have been our original refunded portion. And that coincides with the negative, and it follows through. So that's our total amount of credit for 1 quarter of 2020, and it's $86,277 and change. This is calculated based on all of the steps that Maria and Kim went through to determine what the qualified wages were, what the qualified health plan expenses were, whether anything was used for PPP so that we didn't double dip anywhere. Then you have to actually tell them the amount of the qualified wages, tell them the amount of the health plan expenses. And then just as though if you were amending any type of other tax return, you have to explain why you're amending it. And basically you tell them we're amending due to the changes in the CARES Act that are part of the CAA, and we're claiming our maximum credit of $5,000 per employee. So now we actually have a couple examples. So this one is company A calculated they would receive 70,000 ERC for Q1 of 2021. They have 2 options. They can place the $70,000 on their form 941 that they will file in April and then wait for the refund. Or they can stop remitting the employee-employer portion of Social Security and Medicare, as well as the federal withholdings for their pay periods. So if they assume that their federal employment deposit is $4,000 for their biweekly pay periods, they would not remit $24,000 for the 6 periods in the first quarter, and instead allow the cash to remain in the business. So the remaining $46,000 can be credited to Q2 employment taxes or requested for a refund based on how you fill out your 941. So another example, employer G paid $20,000 in qualified wages to 2 separate employees, each being paid $10,000 in their max for the qualified wages. And therefore, we have a credit of $10,000, $5,000 per person. Obviously, this is based on the 2020. So they need to deposit at least $8,000 in federal employment taxes. There was no sick pay, and there's no mention of PPP. So we can keep that entire $8,000 because employer G anticipated having a $10,000 ERC credit. Thus, they now have $2,000 that they can either request for an advance or they can carry over to the next quarter. Okay. One other example, similar in the same manner, employer E pays $10,000 in qualified wages, which includes health plan expenses. And then part of the Social Security tax was deferred, which is another bill that was signed into law. They should be requiring $8,000 in a federal deposit for those wages. Except they can keep up to $5,000 of that, because this is based off the 50% of the $10,000 qualified wages as if it were 2020. So they can keep $5,000 and it will not owe a penalty, as the IRS has stipulated that they will be reviewing and penalties will not be enforced for deposits that are not filed based on ERC. Okay. So just as we went through the exercises of, is the PPP money taxable or not? The ERC credit is not. It's actually a tax credit, and it's not going to be included in gross income for federal tax purposes. So I'm not going to read this word for word, because this is just very, very much describing how we're calculating what we can deduct and what we can't deduct and how we're going to make the payment. So actually, example 16 is kind of a quick summary of how this is actually going to work. So the employer is going to pay $2,500 of wages. 50% of that could be part of the employee credit, which is $1,250. When paying Social Security tax of the $155, we're not deducting 50% of that. It's only the 50% of the wages. So in essence, we would still be able to say 2,500 minus the 1,250. We're still responsible for the 155. Meaning we would have to deposit the 1,405. All right. I know we've all shared many, 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 many things with you, and I see Ray scratching his head. So we have a couple questions that we're going to go through, and then if anyone else has questions. So if multiple entities are treated as a single employer under the aggregation rules, and only one of these entities has received a PPP loan, does this mean that the other entities are not eligible if they're in the aggregated group? And the answer to that is yes. The employers are treated as single employers under aggregation, so you cannot do the ERC on a separate basis. Question 2, can employers receive both the family medical and medical leave credit and the ERC? Yes, but again, as Kim pointed out with PPP, everything has to be different wages. Nothing can be taken on the same wages. So the planning is crucial in determining what wages are going to go towards PPP, what wages are going to go towards ERC. And then if you have any that you paid out under the family medical leave credit, they would be disqualified for either of those. Okay, question 3. Can an eligible employer receive an advance of the employee retention credit to fund the payment of wages? Yes, the answer is yes. The IRS created a form 7200 that you have to calculate what you believe your ESC credit for that quarter will be, and then you can file that and you can receive an advance on that amount. And when you file your quarterly 941, you would and then reconcile what you've been advanced and what you had already deposited. Question 4, do only small companies with fewer than 500 employees qualify for the 2021 ERC? Loaded question. They must prove that they have a significant decline or the operations test that Maria spoke of, but the number of full-time equivalent employees determine the amount of the wages that the employer will be able to consider when doing the calculation. So yes and no on the answer to the question. Can the business only offset the employer portion of Social Security and Medicare taxes? The IRS has already said that it's not required if there's a reasonable expectation that ERC is expected. So normally your federal employment deposit includes the employee and the employer portion of Social Security and Medicare, as well as the employee federal withholdings. Employees are still going to be credited for their portion of the Social Security, Medicare, and federal taxes withheld, as if it had been paid. This is just another way for the government to keep the business flush with cash, as opposed to submitting it in their tax payment. Okay, must I wait for my quarterly payroll 941 to be filed in order to request the cash payment related to the ERC? So first, we need to know that this is a payroll credit, not an income tax credit. And it's going to affect you a little bit differently. 941s and payroll forms are filed quarterly. So for the first quarter of 2021, that form is going to be due by April 30th, 2021. And we know that most businesses probably haven't even looked at the ERC because it wasn't something that they could take advantage of until the end of 2020. So now we're looking at it to go back and amend these forms and try to get them, either a refund or apply it going forward. However, there's no timetable as to when these amended forms are going to get processed or when that money is actually going to be refunded. It could take up to 4 to 6 months to process these refunds. And also the last part, as I mentioned in the previous slide, if the employer is paying qualified wages, they're not going to be subject to penalties for failing to deposit these federal employment taxes if they believe they will be claiming for an ERC credit. Okay, do I have to wait for my 2021 first quarter to be completed in order to certify the company can qualify for ERC? So as Kim said, for 2021, we can look at the prior calendar quarter test and do calculations based on those figures, and we can use that as our justification for using credits on Q1 2021 and not depositing all of that deposit liability. We don't have to wait till the end of March. We can actually just withhold the cash, and then when we file our 941, we will recognize what we've withheld and what our qualified ERC wages are on our form. Okay. So at this point, I think we're going to open up to questions.
There's one question. Yeah, we have a few moments for questions, and then
Yep.
I'll make some closing remarks. There's a question raised by one of our participants that related to, you mentioned affiliated rules regarding employees, affiliate companies, regarding the number of employees for that 500 employee threshold. Does the same affiliate rules come into play related to levels of revenue as well to take advantage of the tax credits? Do we have to compare apples to apples, or what are the issues with affiliated companies regarding the decrease in sales volume revenue test?
Maria or Kim, do you want to?
So I'm going to try to answer that question. My understanding was that that was really a measurement for looking at the number of employees aggregating, not necessarily aggregating the gross receipts. That was just a test to determine whether you were a large employer or a small employer.
Okay, thank you. Okay. Again, I want to thank Maria, Kim, and Kelly and their entire team at Wilke and Associates for this very timely program regarding the employee retention tax credits available to small businesses. I am sure, I know I did for sure, the participants appreciated all the examples you provided throughout, and I urge all the participants to go back and review the slides. I also urge you to have discussions with your tax professional regarding your eligibility for the credits. Developing a solid tax planning strategy is critical to maximize this program available to your small business. But as you heard this morning, there are ways, as long as you follow the rules, to utilize both the PPP program as well as the employee retention tax credit. But as we learned, there are many stipulations and rules you must follow, and you want to make sure you follow those exactly to receive all the benefits you can. And so, again, I thank everyone for their participation this morning. I remind you that the Small Business Development Center is funded by the U.S. Small Business Administration, the Pennsylvania Department of Community and Economic Development through a program called the Partnership in Regional Economic Performance, the University of Pittsburgh, and our sponsors. Our consulting services at the Small Business Development Center are available to you, and I urge you to reach out. One of our upcoming programs I'd like to highlight is a joint program that we'll be having with the University of Pittsburgh and the Duquesne Small Business Development Center. It will be on the topic of managing debt during these difficult times. Many individuals have added to their balance sheet regarding some debt structures, and on March the 2nd at 10 a.m. we'll be having a program talking about managing your small business and looking at debt and structuring your debt to navigate through this year and beyond. So please look out for the announcement for the program and registration details. A full list of all of our programs can be found on our website, entrepreneur.pitt.edu. And as always, if you have questions, please contact us at sbdc@innovation.pitt.edu or 412-648-1542. So again, you see the contact information listed on the slide. We want to thank again Maria, Kim, and Kelly for their excellent presentation. Their email addresses are there, so if you had a specific question that you may want to get a little bit of their input and feedback, please reach out to them. So this is Ray Vargo wishing you a very great day, and we look forward to seeing you and assisting you in your business in the near future. So this concludes this morning's program. Thank you very much. Have a great day.
Thank you, Ray.
Thank you.
Bye.
Thank you.